Hi, in this session we will study the last part of curriculum, that is alternative investments. Alternative investments is an important topic which lays the base for level 2 and level 3 curriculum, because these are more important in terms of the investment management in the current scenario. In this session we will look at what are the various kinds of alternative investments, what are its key features, how to calculate return on these investments, and valuation of these investments. So let's look at this session. First of all, we'll compare what are the traditional investments and alternative investment categories. By traditional investments, we mean the investments in the publicly traded stocks, bonds, or cash held by the investor. These are typically the long only investments that an investor makes in equity securities or debt securities. Whereas the categories that have emerged as alternative investments are private equity funds, hedge funds, exchange traded funds, real estate, commodities, and some of the other ones as well, like currency, etc. We will look at all these categories of alternative investments one by one in later sessions. Let's now look at some of the key characteristics of an alternative investments. Alternative investments are typically subject to higher fees. Higher fees in terms of investment management. Say for example we compare a normal equity fund to a private equity fund investment. An equity fund will have a large pools of investments which are made in equity securities, and there could be different kind of portfolios separated by the types of investments or the style of investment, and there could be different kinds of managers managing each kind of portfolio. Whereas in case of a private equity fund or a venture capital fund or a hedge fund, the investments are limited, and hence fewer managers manage these investments, and they typically charge higher fees. As we discussed, there are fewer managers managing the alternative investments, which means there is lower diversification of managers, and also the ticket size of these funds are larger than the regular equity fund. Because these funds invest in the form of private equity investment, they are of larger ticket size as compared to a normal equity mutual fund. So typically you will see $100 million fund is deployed in 5 different investments of say average $20 million ticket size each, and hence fewer managers will be required to manage that investment. Also, sometimes the hedge funds and some of the other alternative investments use high amount of leverage as compared to the normal traditional investments. Say for example we take real estate as an alternative investment. Most of the residential real estate investments done by individuals are taken in the form of mortgage investments also. For example, suppose a person is wanting to buy a $500,000 of home. He would typically invest $100,000 or $200,000 of his own money and get the rest as a loan from a bank termed as mortgage. So this is a kind of leveraged investment. Further, there are restrictions on redemptions from these kind of investments. As an investor, if you have invested in a typical equity mutual fund, you can redeem the units or you can sell the investments in the market to a secondary purchaser. Whereas if you invested in a private equity fund or a venture capital fund or a hedge fund, there are restrictions on redemptions because they are subject to some base minimum lock-in periods. Also, the investments made by these funds, like the PE fund or the venture capital fund or a hedge fund, the underlying investments are illiquid in nature, unlike the investments made by an equity mutual fund or a bond market fund, etc. Also, There is low transparency and limited regulations that apply to these alternative investments. And since these are the recently evolved types of investments, there is limited availability of historical risk and return data to analyze for an investor or an analyst. But it has been observed that these alternative investments have very low correlation to the traditional investments, meaning that if the traditional investments are increasing in value, typically the alternative investments are not increasing in value by the same factor, or in fact going in the opposite direction, and vice versa also. That relates to the lower correlation with the traditional investments. And the last point is the alternative investments are subject to unique tax and legal implications in the various geographies as well. Now let's look at some of the returns and structures that are applicable to the alternative investments. The returns for an alternative investments are typically classified based on the type of management of the fund. Most of the alternative investments are actively managed, and hence they typically strive to generate the alpha return, that is the positive alpha return, which is over and above the normal return expected from the market investment. Then only it is worth the risk that an investor takes of investing in an alternative investment. So the total return here is the total of alpha return and a beta return. Typically beta return is the normal market return that an investor would expect considering the riskiness of that investment. Alpha return is the return that is generated from the active management of the portfolio by the fund manager. The typical structure of an alternative investment is most probably in a partnership form. So most of the private equity funds or the venture capital funds or hedge funds is a partnership form. So there are limited partners and general partners involved in these kind of funds. The fees. Like an equity mutual fund, there are management fees for the alternative investment funds also, that are typically based on the AUM, which is all assets under management. So there could be various kind of fee structures also for these funds. So for an alternative investment there could be a base fee, and also there would be an incentive fee or a performance fee which is linked to the realized profits that the fund manager can generate from these investments. Sometimes there would be a hurdle rate that is decided, that the incentive fees will only start kicking in once the fund manager has achieved a minimum hurdle rate of return for the investors or the partners. Let's look at some of the equity mutual funds and its features. There are typically two types of equity mutual funds, an open-ended fund and a closed-ended fund. Let's look at their characteristics one by one. An open-ended fund is continuous offering, which means there is no limit to the number of units that a fund can issue to the investors. The shares are created and redeemed at NAV, and this NAV is typically calculated at the closing prices daily of the underlying investments. There are no short sales allowed for an open-ended mutual fund units. And the typical fees that an open-ended fund would carry are sales and redemption fees, management fees, and distribution fees. Sales fees are the fees that are charged at the time the investor invests in the open-ended mutual fund units, and redemption fees are charged when the investor exits or redeems his units from the mutual fund. Management fees are typically paid for the maintenance or expenses that the fund incurs on hiring the fund managers. And the distribution fees are charged for selling the mutual funds or maintaining or absorbing the cost of selling or marketing the mutual fund units to the investors. Against this, a closed-end fund has a fixed number of shares only. It is normally issued in the form of an IPO, like an IPO, initial public offering. These shares or units of the mutual fund, which is a closed-ended one, trade like stocks in the market, and hence an investor can short sell that, and also margin buying is allowed on that. These shares may trade at a slight premium or discount to the underlying NAV. There would be bid-ask spreads because they are traded in the secondary market, and there are normal management fees applicable. Now let's understand how the net asset value is calculated. The net asset value is representing a fund's per share or per unit market value, which means that all the underlying investments of the fund are valued at the end of the day at the closing prices, which will give us the value of the fund assets, plus you add any cash position that the fund is having at that point in time, and from that you reduce the current fund liabilities, the liabilities that the fund is expected to pay or is currently outstanding on its books. So that will give you the net asset value, and you divide that by the number of shares outstanding at that point to get the NAV per unit or per share of the mutual fund. This is computed at the end of each trading day based on the closing market prices of the portfolio securities. Remember, it's a very important point. NAVs for an equity mutual fund are calculated daily at the closing prices. Let's just look at briefly what are the various equity fund strategies or funds that are available. The equity fund strategies could be by the style of investment, whether there is a value investment style or a growth investment style, or there could be equity funds focused on large cap investments or small cap investments as underlying investments. Or there could be sector based funds, so healthcare sector focused funds, or fund which is focusing on investing in securities in the energy sector or infrastructure sector and so on. Or there could be index equity funds, the equity funds which are trying to mimic the index strategy or the portfolio. There are S&P 500 funds, Nifty 50 fund, FTSE or CAC, etc. These various types of index equity funds are available. And then lastly, there are global equity funds, the funds that focus on global investments. So there could be an emerging markets focused fund which invests in securities in Brazil, Russia, India and China, or there could be an Asia Pac fund, or there could be a MENA fund, that is Middle East and North Africa focused investments.